Good evening. Let's talk about values and not ethical values. I'm a finance guy, so let's talk about financial values. And I guess you know these firms. You are in contact with them probably every day. And the question is, what makes the value of these firms? Is it their tangible assets? So is it the machines that they use, or the factories, or the buildings? Probably not. It's probably something different. It's their intangible assets. They have strong brands. They have created that over time. They invested a lot of effort and money to create them. They have patents, technology, they have knowledge, big data that they use and big data that they sell in order to earn money. So I guess you agree it's something that's very valuable and that makes these companies very valuable. And this is also acknowledged by the market. And that has dramatically changed over the recent years. If you look at that. 40 years ago, the value of firms was more or less determined by the tangible assets. The machines, the buildings, the factories. Now it has completely changed. So nowadays, estimates say over 80% of market values of firms are determined by the intangible assets, the brands, the patents, etc. Now, what's the amount? How much is that worth? All that intangible assets that companies own and that they have created? It's $8 trillion. $8 trillion. So imagine that. I guess you would like to have a part of that. Yeah? $8 trillion. Think of 8 trillion $1 bills. Yeah? And you stack them on each other and you lay them on the ground, and then you would like to wrap that around the earth. How many times can you do that? Once? Twice? 20 times. 20 times. So this is the overall value of intangible assets that companies own and that they create. And my students know this. And also the executives I talk to, if you would like to know something about firms, how good they are doing, how they are earning money, where do you go? Where do you look for that? Of course, financial statements. Yeah, financial statements report about, or should give us information about, how good or bad a company is doing and what are the assets that they own and that they have created. So let's take a look. Let's take Apple as an example. I guess we agree Apple is a strong brand, maybe the strongest brand that we have all over the place. And this is how Apple earns money. That's why you are willing to pay much more money for an Apple notebook compared to any other notebook, or for your iPhone compared to any other smartphone. So this is probably the key driver. So let's take a look. Let's take what is the financial value of the brand of Apple. You're going to look in the balance sheet, but you don't find anything. Nothing. There's nothing said about that. And that is weird. Why is that? Is it because Apple does want to hide that somehow? Maybe. Maybe they really want that. But it's very easy for Apple. If you go to Apple and ask them why you're not showing that, they will simply say, these are the rules of the game. It's prohibited. It is not allowed. The rules of the game, the accounting rules say it is not allowed to put an intangible asset that a company has created into the balance sheet. And that's weird, if you think of probably the importance of these assets and how this helps firms to earn money. I'm an accounting professor, so I would not dare to say that. So I'm referring to Philip Kotler. He's a very well-known marketing professor. And because of this observation, he says the modern balance sheet is a lie. That's a very strong statement. So if I would have said that in the classroom, it would have been difficult to convince you about the importance of financial accounting. Anyhow, he has a point. So there's an estimate. So the Apple brand may be worth something like 170 billion US dollars. This is huge. Of course, this is huge. And this is probably more or less reflecting the importance of this intangible asset for Apple. Now the question is, why does it not show up? And why should it show up? What is the key principle of accounting? My students know that. It's usefulness. So why are companies every year collecting these tons of data, investing so much money and so much time to create these financial statements? Because of usefulness. We are interested in these firms. We are stakeholders. We may be an employee. We may be a customer. We may be an investor. You would like to know something about the value of the firm. And the companies should provide us with useful information. That's the idea of financial statements. But now there is a rule out there saying it's not allowed. It's not allowed that intangible assets show up in the balance sheet. And that is weird. If you say, yeah, okay, I may be a stakeholder, but why should I care? I think we should definitely care about this situation, and it's something that should definitely be changed. Take the dot-com bubble. What was that about? If companies do not report about their assets, especially the intangible assets, what are we doing? We start to estimate. We start to speculate. And this is maybe something that happened at the beginning of the century. What were these companies that have been listed on the Nasdaq, what have they been offering? Factories? Have they built machines, buildings, whatever? No. They have built intangible assets. They offered data or patents or knowledge, software, maybe already a brand. But the accounting standards say you're not allowed to report on that. What happens? The market overshoots. They start guessing, speculating, and this is maybe a reaction. So think about that. How many people lost their shirts in their time? Yeah, so it's tremendous. And that's why this is something that should be much better taken into account. The question is, why is that? I mean, are the accountants stupid? What's the key argument that accountants say why intangible assets should not show up in the balance sheets? It's a measurement issue. So referring back to the Apple brand, it's an estimate. And this is, of course, a challenge. I think we all agree on that. It's probably easier to value an intangible asset like a building or a car where you have a market. But for intangible assets, it's much more challenging. But anyhow, companies are not forced to do it, so what are we doing? We start to estimate, we start to speculate. The problem is, and that's the argument, is that many companies are now trying to understand and try to evaluate these financial assets, these intangible assets, the value of the intangible assets. And there's variation, because it is a challenge, and there are different approaches how to do that. And this is what you see here. And of course, it makes a difference if you take an intangible asset that is 170 billion US dollars, or if you take an intangible asset that is maybe 250 billion US dollars. It's the same intangible asset, it's the brand value. But there are different approaches. And that's the argument. And maybe accounting has a point there. I may agree. But now it gets really confusing, and now it gets really contradicting. There's a situation where companies then indeed have to report on intangible assets. It's a very specific situation. It is when one company buys another one. Let's take a big example. Procter & Gamble buying Gillette in 2005. What has Procter & Gamble bought in that situation? Machines, of course. Some factories, yes. Buildings, okay. But it's Gillette. It's the strongest brand in that sector. Knowledge, patents, customer relationships. And now the contradicting thing, the weird thing in the accounting standards, in the accounting rules, in the rules of the game is, in such a situation, you have to measure the value of intangible assets. And that is what Procter & Gamble had to do. So this is what they had to report on. They said, this is how much we bought, there are some tangible assets, and now they have to put a value on something like the brand, on customer relationships, on patents. So that's weird. On the one hand, the rules of the game say you cannot measure it, but in a specific situation they say you have to measure it. So why can't we use the approaches that we have seen in this context and transfer that to a normal situation when a company is having created a certain intangible asset, and then we apply these approaches? How could it work? For example, and this is then maybe one idea, we look at the investments. What is the investment for an intangible asset like a brand? It's advertisement. Accountants may say, okay, advertisement, this is usually an expense, but maybe we should consider something like that as an investment. And if it's an investment, it shows up on the balance sheet. And these are somehow approaches that are used in this context, and I do not understand why in this context it's possible to measure, and companies have to report on that. But in a normal situation, like for Apple, there's no information at all about the value of these so much important intangible assets. So in other words, there's the reality. The reality is more than 80% of market values is captured in intangible assets. 8 trillion US dollars, the value of these intangible assets. However, there's a gap. And the gap to the accounting world is that we have balance sheet and financial statements not really reporting about that, although it's so highly relevant information. It's very contradicting, and that must be changed. So the question, intangibles in the balance sheet, to be or not to be, I will answer that very clearly and very simple, to be. Thank you very much for listening. Okay.
That's right. The first one is, what would change in management if accounting standards would change with regard to the reporting of intangibles?
I think it would change a lot, right? So take the marketing field, right? So the marketing field always is under pressure every time if something is going wrong in the economy. And why is that? Because it's always expensed. It never shows up in the balance sheet. It's never an asset. So internally, marketing will have much stronger voices, will be much more appreciated, for example, if the marketing would more show up on the balance sheets. So this would be one example where I think this has tremendous changes or will bring tremendous change in the management, because many people are working on these intangible assets and the work is not really appreciated because it does not show up on the balance sheet. It's not considered as an asset.
Thank you.
Okay, then I guess what we're all thinking is the modern balance sheet a lie? Like, what would you say then?
Of course, this is very provocative. The question is, if something is incomplete, is it already a lie? I think everything that we find in the financial statements, it's very heavily investigated, examined, there's auditing going on and so on. But I think what is really missing is here one very important information. And so it's not a lie, it's incomplete. Okay. And incomplete is also something which is not something we would consider as being optimal, and especially in that context. And I think this is something that must definitely be changed.
Okay, well, thank you very much.
Okay, thank you.
Great.